You're watching BloombergQuint. We are taking stock of the state of the Indian economy. The debate continues. 5.7% GDP growth in Q1. Does it tell you a story of a slowdown that has been kicking in for quarters now? Or is it something that could just pass us by once the demonetization and GST disruptions fade? That's the big debate and the question being put across this time around to Jahangir Aziz, the head of emerging markets and economic research at JPMorgan, who's in Delhi at a JPMorgan conference. Jahangir, thank you so much. Appreciate you taking the time to speak to us. Everybody has a different theory, Jahangir. Some say it's exports, some say it's the twin balance sheet problem. What's your own gut feel as you look at the data? What's causing this slowdown and how long do you suspect it'll persist?
Right. So, obviously we've been struggling for the last 3-4 years to make sense of the CSO's GDP estimates, and this is not something new. But if you look at higher frequency indicators, look at credit growth, look at in industrial production, look at non-oil, non-gold imports, look at freight, etc. They had been pointing to a slowdown in the economy for quite some time. And even though you might have questions about the levels of growth that the CSO has been printing, at least the trajectory of growth has been that it's been on a downward trajectory almost for 4 or 5 quarters now. And I know that a lot of people want to attribute this to things like demonetization, GST, but one needs to step back and look at the fact that the trend has been going on for 4 or 5 quarters, way before either demonetization or GST was even in the horizon. So I think there's a deeper reason as to why India is slowing down, and I would suspect that it probably has to do with the fact that India grew on the back of globalization, on the back of global trade. Now, many will disagree that no, India is a closed economy. In reality, India may have been a closed economy some time back, but over the last 10-15 years, external demand has been the key driver of growth. And I think the decline in global trade that has been taking place in 2012 onwards finally hit India's manufacturing and services. And I think that is probably a bigger driver, the lack of demand, the lack of external demand, and the fact that, over the last 3-4 years, we have not replaced external demand with something domestic.
All right, Jahangir, this theory or this issue about exports and how much that has contributed to the slowdown, we were having a conversation with your colleague Sajid Chinoy recently, and he was making the same point. But another one of your economist friends, Niranjan Radhayaksha of Mint newspaper, had told us that there is a counter to that you should look at net exports rather than just exports to judge how much this export story has played into the slowdown. Which side would you lean towards?
Look, I mean, net exports is arithmetic, right? That has no analytical content at all. So think about how India grew from 2003 onwards. What was a key driver of India's growth was this massive rise in corporate investment. Corporates, finally, after decades of languishing, corporate investment shot up from like 6-7% of GDP to about 13-14% of GDP. Now, all of that investment created capacity. The question that needs to be asked is that all of that capacity that this new investment created, who was consuming it? Who was absorbing it? And it wasn't Indian residents or Indian domestics who were consuming that increase in capacity. It was most of it was being driven by foreign consumption or foreign demand. So in that period of time, when investment grew from private investment grew from 6-7% to about 14-15%, at that point in time, it was exports that went from around 12-13% to 25-26%. And by the same token, you had private consumption actually declining as a share of GDP. So yes, net exports, the problem I have is it's just an arithmetic identity. It's just a residual. That doesn't really tell me what is actually happening in the economy. What is actually happening in the economy is told by what's happening to investment, who is absorbing that capacity. And as I said, I mean, it's been mostly exports that's been driving India's growth at that point in time, and continues to be the key engine that has failed to deliver growth.
All right, Jahangir, I think the other debate is also on the currency and the role that the overvalued rupee may or may not have played in the export story or the export slowdown story. My question simply there is, what can the RBI do? They've sucked out pretty much all the capital flows that have been coming in this year. You have a weaker dollar and hence a stronger rupee. What can you do, even if a rupee is partially behind this export slowdown?
Absolutely, and we have never said that the reason why Indian exports is languishing is because the rupee is stronger. The strength of the rupee is a factor, but the strength of the rupee or the strength of the local currency is a factor in China, is a factor in every Asian economy, because if you look at real exchange rates across Asia, they're all appreciated in this period of time of the last 3-4 years. What we need to understand is that there is a massive amount of excess capacity globally, even today, even after the global recovery in developed markets and in emerging markets. There's a massive amount of excess capacity that exists, which is why if you look at manufacturing, barring, I would say, memory, DRAM, everything else is disinflating and continues to disinflate. In a world with that kind of excess capacity and where global trade is not actually, the global trade pie isn't really rising at the pace that it used to rise today, it is very difficult for people to just take away market share just by changing the exchange rate or undervaluing the exchange rate. You really need to bring down the cost of production, and that's where I think India has fallen behind, is that it hasn't managed to bring down the actual cost of producing things. And in fact, over the last few years, I think the cost of doing business in India for a variety of reasons has actually probably gone up relative to other countries and not gone down. I think that's where the key is. It's productivity slowdown, it's efficiency losses, and it's not really a problem that the real exchange is too appreciated. I'm sure it has some impact. I'm not saying that it doesn't have any impact, but key is that we haven't really pushed productivity up in the last 3-4 years.
Jahangir, there's another sort of story within this export slowdown story, which again your colleague Sajid Chinoy had pointed out. Would love to get your thoughts. And that is that the disruption caused by demonetization could have had a bearing on the trade picture, particularly on the import side, because we saw import spike. Do you think the shift to the formal economy is sort of disrupting things on the export and on the import side?
Right. So I think that that's much more a story related to, probably the impact of demonetization that most people do not look at. So when demonetization happened back in November, we basically made the point that, look, we agree with everybody else that temporary demand shock is probably going to be the biggest casualty of demonetization, but it's going to be temporary. Once the liquidity comes back to the system, the demand is going to come back. Now, if you look at what's happened, liquidity has filtered back into the system, and we have seen demand pick up. What we had feared was that perhaps demonetization would also disrupt the supply chains that runs through both the formal and the informal economies. And if those supply chains are disrupted, then this pickup in demand, which would have happened and which is happening right now, wouldn't get fulfilled by domestic production. So if you look at industrial production, that hasn't really picked up. That has been languishing and remains at these levels pre and post demonetization. What is really what is now, how that demand is now being fulfilled is by imports, and that's why non-gold, non-oil imports has been rising. And a lot of people will also say, well, that's because INR has appreciated against the CNY. We've looked at the shares of Chinese imports in our overall import basket, and shares of Chinese imports, by the way, haven't changed at all over the last 1 year. So yes, the appreciation of INR versus CNY does have some impact. Again, I'm not going to say that it has no impact, but really I think these are signs that perhaps there has been supply side disruptions taking place and not just temporary demand side disruptions caused by demonetization.
That's very interesting. Jahangir, just want to take you in a different direction, and that's the government finances. There's been some talk of a fiscal push. More people are not calling it a stimulus, but a push. But the government's finances, both centre and state, are not looking particularly healthy. What do you think?
Look, I mean, we have been talking about this for a long time. You know, it's almost, we are now sounding like, almost like a broken record, that everybody had focused on the central government's budget, and which had been consolidating over the last 3 years, maybe not at a pace that we would have liked, but it was consolidating. But if you look at the entire consolidation by the central government, all of that was completely offset by very profligate state governments, and such that the center plus state fiscal deficit, overall fiscal deficit for India, has remained around 7% for the last 3-4 years. Which means that, look, take away the last quarter 5.7% growth rate. If you take away the 5.7% growth rate, in the last 3 years, India probably averaged 7-8% growth rate. We will not quibble about CSO's estimates at this point, but 7-8% growth rate. And remember also that oil had averaged probably around $40-45 a barrel during this period of time. So if with 7-8% real growth rate, $40-45 a barrel oil, if India cannot reduce its overall deficit from 7%, it means that we have been running this entire growth over the last 3-4 years, probably on the back of very large ongoing fiscal stimulus. So I think that is, it did not worry us very much, because the current account was under check. But now that the current account is beginning to rise again, I would say that, yeah, I mean, one should be looking very carefully at what's been happening to the fiscal front. But I would say look at both center and state. And this is not a new phenomenon. This has been going on for the last 3 years. We just didn't pay attention to it.
So you certainly won't be a votary of some sort of fiscal push or stimulus right now.
Yeah, I mean, to think about it, I mean, we already have a massive stimulus going through. How much more stimulus do you need in this economy? And remember, I mean, we've been through these phases of fiscal stimulus. In India, fiscal stimulus has always ultimately ended up in tears. Go back to the 2008-9 fiscal stimulus. We gave that we provided fiscal stimulus. That stimulus was based on cutting indirect taxes. Therefore, it had immediate impact. It was not based on expenditure, which was the good thing. But then we did not withdraw the fiscal stimulus once growth went back to the 8-9%. And that's the difficulty of giving fiscal stimulus. Everybody wants the fiscal stimulus, but nobody wants to withdraw it. We started withdrawing the fiscal stimulus only when taper tantrum hit India and we had to adjust. So again, these kinds of fiscal stimulus packages, etc., you can make it short term, you can make it near term, you can make it contingent. We in India never have had very good experience with fiscal stimulus packages.
All right, Jahangir, one last question, and this one on monetary policy. There it looks like we are pretty much on track, at least in terms of bringing inflation down close to levels that the RBI has projected. Although there are still those who argue that real rates are still too high and should be cut. But what is your take, or what is your expectation of monetary policy in India from here on?
No, look, real rates are too high. Real rates are too high compared to what things used to be back in, let's say, 2000, in the pre-GFC period. And real rates are too high if you compare where real growth rate is and real policy rates are. But this is a phenomenon across the world, across the emerging market world, where the gap between real growth and real policy rates have shrank massively. So this is not an India phenomenon. But turning to India's own inflation experience, if you look at the last few months of inflation, core inflation is back up. Maybe it's because of GST, and therefore the RBI will see through it. But if I look at what's happening to inflation dynamics right now, based on core inflation, even with an economy that's slowing down, it is very hard to see in first quarter of 2018, which is really where the inflation target should be judged, because inflation target is a forward-looking objective. It is very hard to see inflation, let's say in the first quarter of 2018, below 4%. So if that's not going to happen, and we are not in a position where we can see with clarity that inflation will be below 4% by a comfortable margin, it is very hard to see RBI cutting rates and providing any kind of stimulus. And even if you can probably squeeze out one more rate cut out of the RBI, but really it's not really going to make much of a difference. And it's going to make the financial markets happy for a week or so, but that's about it.
All right, Jahangir Aziz of JPMorgan, thank you so much for joining us. A great pleasure speaking to you and getting your take on the state of the economy. That's BloombergQuint. BloombergQuint.com is the website. All those stories plus news stories on the finance minister talking about the possibility of some sort of government measures coming in, all that on the website. Do tune in and do keep watching.